the December CPI came out last week, and it was hotter than expected. So the actual number was 3.4% year over year, and the expected was 3.1%. And I think the previous month, so this was for December 2023 for the United States. For November, I think it was also 3.1%. So it did tick up quite a bit on this December report. So this scared a lot of people, and as a result, the Fed Watch tool, which is the CME Watch tool, which is like what I go to check what are the percentage probabilities of rate cuts in the future. So it's saying that there's pretty much no chance of a Fed rate cut in January, which is the next FOMC meeting coming up. And for the one in March, before this report came out, I think it was at 70 something percent of a rate cut starting in March. And now basically it's 50-50. So it's just a coin flip on whether rate cuts will happen in March or if it's going to get delayed to May, which is the next one after that. There's no FOMC meeting in April for some reason. But yeah, anyways, so yeah, what do you guys think? I know here in Canada, we just posted our CPI for December, and it was also 3.4%. And it was, I think in Canada, it was actually in line with expectations. So analysts were actually expecting 3.4%, but it still represents a tick up from November. So it looks like in December, inflation in both the United States and Canada ticked up noticeably. Part of it was driven by gas costs, but part of it was also driven by the price of, I think food was one of them. But yeah, did you guys notice that prices have gone up for you guys? And what do you think? How do you think this affects the chances of rate cuts, both in Canada and the United States? And how does this affect stonks in general?
You see the price of olive oil these days?
I know it's so expensive. It's nuts.
Yeah, no, I went to No Frills, which is a grocery chain here in Canada. It's owned by this big conglomerate called Loblaws, which everybody loves to hate and hates to love, I guess. here in Canada, No Frills. And yeah, so there was two kinds of like the high quality ones. So there was the no name ones, which were still under $10 Canadian per bottle, but I'm not exactly convinced that those are real olive oil because I don't know, like the color is like a lot lighter than what olive oil should be, and I think it's probably like cut with like canola or something. But if you want the actual like good olive oil, the like Greek ones were like $16.99, so $17 for the Greek olive oil. And there was one that was certified from Kalamata, which is this like species or this region in Greece that had the stamp on it, and the stamped one was $19, so $18.99 per bottle, and the bottle was 750 milliliters. So it's not even a liter, and it's almost $20. So yeah, it's gone quite insanely expensive in Canada. So yeah, I was wondering what you guys think of it. Have you guys seen food inflation speed up once again? And if so, how do you think this affects the economy?
I mean, like day to day, like when you're buying groceries and such. I used to live in Ontario with my parents, but now I moved over here. Life is pretty expensive, I'd say. Buying your everyday necessities are pretty pricey. Let's just say that, whether it be like bread, eggs. I'm definitely noticing the difference for sure. But Andy, I actually wanted to ask you, when do you think the next projected rate cut will happen then? Like according to like how you feel and like what you think.
In Canada or in the US?
How about we'll just say both?
Okay, so in the US, I want to say that the first rate cut will happen in March, still, because Yeah. Finger crossed.
Please.
Yeah. So I think the reason for that is because if you look at Trueflation, so I'm not sure if you guys have been on Trueflation. If not, you can like search it up right now, trueflation.com. It's like an independent organization that measures inflation in the United States. And according to their numbers, the true inflation rate in the United States is already under 2%. So I think it was 1.85 or something last time I checked. So, you know, I think I want to say it's my opinion, but I think it's actually a fact. But I'll just say it's my opinion for now. But it is my opinion that trueflation precedes CPI inflation, right? So if you look at the trend of trueflation, it's been plummeting like crazy, right? And the CPI is low, so it doesn't capture that. But I think in the subsequent months, you will capture it. And I think December was kind of a fluke because it was the holiday season and you know, as we come out of COVID, I think you're gonna have people kind of consumer confident kind of increase, and also I think the stock market was doing well in December, so that kind of wealth effect, even if you don't sell your stocks, just seeing that number go up in your account is kind of gonna prompt you to spend more money, I think, right? And it's called the wealth effect. So I think that had a big part to do with it. Whereas if you look at December of 2022, um, like the stock market was kind of in the dumps, right? So like the wealth effect, it was kind of a reverse wealth effect back in December of 22. So year over year, if you compare 23 December 2023 to 2022, you're probably going to see a big increase, and I think that that shouldn't be surprising. But going forward, I think you're going to see inflation kind of tick back down again. And you're going to see jobless claims and unemployment go up. And I think that that's going to really um, kind of prompt the Fed to start rate cuts. So I still think that the first rate cut starts in March for the Fed in the United States. For Canada, I think it's going to come later. So not March, but probably in the summer. So like June or somewhere in that area. Just because I think that the Bank of Canada is really wary about capital flight to the United States, right? So if they start cutting rates before the Fed does, or even at the same time, that's going to prompt people to kind of flee the Canadian market and put their money into the US market. Because if they start cutting, the US is staying flat, then the US dollar is going to go up against the Canadian dollar. And that's what they don't want. So they're not going to cut before the US does. And preferably, they want to wait until the US starts cutting, and they want to wait like, you know, a few months or maybe even a few quarters before they start cutting. But that's just my opinion. What do you guys think?
I'm speechless. Yeah, that sounded just about right. How do you like top that one off? Yeah, it's good to know. I didn't know that like there'd be such a difference between the States and Canada, but it kind of makes sense too, from your explanations. Yeah, that's why I want to ask you specifically because I think you're most knowledgeable in that regard. So I don't know if Tristan has anything else to pinpoint into.
Yeah, I think that inflation has been definitely higher than what they've been claiming it's been. I'll say that. So, the rate that everything seems to be increasing has been, they say it's 5% or whatever, and then it really, or like 3% in this case, but it really feels like it's going up a lot faster than that.
Yeah.
It's definitely been coming down from what I can tell. So I think that's fair, but it's I don't think we're out of the woods yet. I think that there's still plenty of time for our dollar to get eroded more.
So here's a question for y'all. If you were the Fed, would you cut rates in March or keep rates steady?
Huh.
And by cut rates, I mean just a 25 basis point cut.
Well, it depends like on the next few CPI reports. Is that is that how that works too? Because if numbers are going really well, then it would be time to cut rates because
Yeah, so that is how the Fed kind of operates. So they want to wait till the data kind of comes in. But let's just say that like we don't get a super hot inflation that's above expectations again. But we get let's say it goes down slightly, right? It goes from 3.4 back down to 3.1, and then maybe a month later it goes to 3.0. Like if the trend of downward CPI reports continue for the next 2 months, and again, we don't have that many CPI reports until March, right? I'm not sure if the February CPI will come out before the March meeting. I think it does, but
Hmm.
we still have to get the January one. So at most, you're going to get two more reports, right? But assuming that in those two more reports, CPI inflation comes back down to 3.1 or less, if you were Jay Powell, would you cut rates?
Probably.
Huh.
If it's trending down, I feel like if it's trending down, at some point you have to decide to cut rates.
But
I would say the
keep in
fact that there
mind,
was an upset. So
but keep in mind the target of the Fed is 2%. So you don't
um,
think that they should wait till it hits 2% to cut, or you think that they should start
uh,
cutting now?
I don't think that they can afford to wait till 2% to start cuts, because I think it will decrease in general, like because of the higher rates. But even if they cut the rates by 25 basis points, it's still a high rate, right?
You're not scared of the Houthi rebels with their like 1970s
I
Soviet
was,
technology
you
blocking
know,
the Red Sea?
I was gonna mention that
Ooh,
wait, Andy, correct me if I'm wrong. So there was a time where interest rates were going super duper high in like the 70s or 80s, right?
Mhm.
And I think they started to cut a little too early, and because of that, it kind of messed up the entire economy. So you think Jay Powell's trying to like not cut super duper early? So in that case, maybe he's not going to cut quite yet, and not until the summer, because he just wants to make sure everything's okay and not repeat history one more time,
Yeah. So that's exactly right. And
right?
for background, in case you guys don't know, and maybe our audience members wouldn't know this as well, but there's in the 70s and 80s, there's a tale of two Fed chairmen, and their names are Arthur Burns and Paul Volcker. So what Burns did was, he was kind of wishy-washy with, increasing rates and decreasing rates, and as a result, um, because like he increased rates too slowly, and I think he also decreased rates too fast. Inflation like spiked up, and like inflation became out of control. And then they got a new guy, Paul Volcker, the new chairman. And what Paul Volcker did was, I think he hiked rates up to like, I think it was 20%, 20 something percent at its highest. So just to give you guys an idea, we're at 5.25 to 5.5. It's the range, right? But yeah, we're at 5.5% right now on the maximum end. And Paul Volcker did 20 something percent. So that crushed inflation, but it also, you know, crushed anyone who was trying to take out money for like a mortgage or for like a loan or anything like that, right? But it did manage to control inflation, and it crushed inflation. So I think the kind of debate right now is that Jay Powell, he's not a young man anymore, right? He's not gonna live forever. He wants to leave a legacy as Fed chairman. And Jay Powell wants to be a Paul Volcker more than he wants to be Arthur Burns, because Burns was seen as a failure, versus Paul Volcker was like, the person that kind of came in and did what was necessary to fix the issues, right? So he wants to be remembered as a Volcker, not as a Burns. So
he ain't going
that's
to 20%.
yeah. So unfortunately, the United States national debt is at 34 trillion as of making this video. So by the time you guys all watch this video, it might be like 35 or 36 trillion, because apparently it's going up by like a trillion every 6 to 8 months. But anyways, 34 trillion. If you do the math, if you have to pay 20% interest on that, that would just crush the entire economy in an instant. So unfortunately, Jay Powell cannot raise interest rates that much, but arguably he doesn't need to, right? Because he raised to 5.5, and already there are some industries that are getting crushed, and there are signs of recession popping up in various places. Although we're not arguably in a full blown recession quite yet. But yeah, anyway, so it's kind of like a debate, right? So like I am not jealous of Jay Powell's job at all because I think it's actually a very difficult job. And if you make a mistake, you kind of ruin it for like not only Americans, which is like a large portion of the world's population at this point, but also for the world, right? Because whatever America does, everyone else tends to follow. And I always like have this joke where the Bank of Canada governor has the easiest job in the world because all he does is copy Jay Powell's homework, right?
Exactly.
So yeah, it's just whatever America does, whatever the Fed does affect the entire world. So yeah, it's a difficult thing.
I mean, to add on to that too as well. America is currently like the leading currency of the entire world, so anything they do is probably really important coming from me. And didn't that happen with the British Prime Minister? She tried to lower rates and it kind of messed up everything, and then they had to switch it over. What was the story again?
Yeah. So what happened with Liz Truss is the woman you're thinking of, and
Yeah,
her
exactly.
like premiership or prime ministership, however you say it, lasted shorter than a head of cabbage. Like, did you see that video where like somebody put a head of cabbage next to a picture of Liz Truss, and it's like who will last longer, Liz Truss as prime minister or this head of cabbage? And the head of cabbage actually outlived her premiership